Good afternoon, everyone, and thank you for joining us this afternoon for our year-end tax webinar. We have the joy again this year of trying to predict taxes when we don't know what the rules are going to be. So it's fun times as usual, but this is the new normal, so we're going to just move ahead. My name is Mark Heath, and I'm Partner and Director of Tax Services here at McKonly Asbury. With me today is Charlie Eisenhart, the one and only. Charlie's going to give us a whole bunch of updates on the 1040 side of things. I'm going to chime in here and there, and then I'll be stepping in to talk about some, not necessarily corporate changes, but possibly corporate and flow through proposed changes and how we can talk about planning for those going forward. We're here at McKonly and Asbury. We are a full-service accounting firm with 3 offices located in Camp Hill, Lancaster, and Bloomsburg. On your screen there, you can see the industries and services that we focus on. And as always, we would be thrilled to talk to you and answer any questions that you might have. With that said, I'm going to turn it over to Charlie, who is going to take us away on the individual side. And one last thought for CPE. Pay attention, there's going to be 4 polling questions, answer those, and you will get your CPE, and we will try to make a lot of noise when those questions come up so you don't miss them. Charlie, take it away.
Thanks, Mark. Hey, everybody. All right, let's talk about everybody's favorite thing, taxes. Let's go to the first slide. So the first thing we're going to talk about is the child tax credit. There are 6 major changes this year from last year. It's probably the thing that got the most headlines over the summer. A lot of people got checks for a lesser amount, 1/12 of the amount, so it was spread out over the last 6 months of the year. So here are some of the changes. The age is up 1 year. The child credit has also gone up from $2,000 per child last year to up to $3,600 if your child is under 6, or $3,000 if your child is 6 or over. In the past, the credit was partially refundable. Now it's fully refundable, and there used to be an income limit. Now there's no limit whatsoever. So some families who really need that money, who maybe didn't have enough earned income, they're going to be able to get that credit fully refunded. There was no advance payments, obviously. And like we said, the payout was from July to December. The phase out begins last year was from $200,000 for a single person or $400,000 for a married couple. This year, the credit starts to phase out at $7,500 for single and $1,500 for married filing jointly, but it only gets, that's when it gets you to the $2,000 limit from last year. It still goes at $200,000 and $400,000. So if you made in between the $150 for a married couple and $400, you're still going to get that $2,000 that you got last year. You're just not going to get any of the bonus credit that's out there. So the other thing is that this is an advancement of the credit. And so if you took more than you were supposed to, you're going to have to pay that back. So it is something that people are going to have to pay attention to. If they had less money last year and they made more money in 2021, they may see they're going to have to pay back some of that advancement. So, all right, let's go to the next slide. Our next slide is the dependent care credit. This is for child care. And this is one credit that, Mark, a lot of our clients forget about, because it normally is one of those credits that anybody can get, whether it be, somebody who's a bagger at Giant or somebody who is the CEO of Coca-Cola. Everybody used to be available for this credit. So it's one that people tend to overlook. Assuming both you and your spouse work, you can earn up to a 20% credit on $3,000 worth of childcare. So there were some changes this year, because anybody who has kids in school knows, or in childcare knows, that $3,000 doesn't even come close to cutting it. And so they raised that number to $8,000 for one child, or $16,000 for more than one child. So if you have 2, 3, 4, 5, or the Duggars, and you have 19, you're still only getting $16,000. The max has also gone up. It was 35% down to 20%. And this one, it goes from a max of 50%, but it does phase out. So now the CEO of Coca-Cola is no longer going to get that tax credit, that small $600 tax credit for sending their kids to school. The credit phase out began at $15,000, but now it only doesn't begin to $125,000. And it never ended before, and now it ends. The credit is fully refundable. And so there's that. The one thing that a lot of our clients tend to overlook also is that it also is for eligible for physically or mentally disabled dependents or spouses. A lot of times when we think about this, we're thinking about our younger children. But now, if you have someone who qualifies, it is possible, given certain income standards, that you could get this credit for a parent or a spouse that you're taking care of.
Yeah, like you said, Charlie, this often it gets overlooked, gets forgotten, because this credit was designed to incentivize people to go out and work, have earned income, and obviously in order to do that, if both parents in a household have jobs, then you obviously have to have childcare, depending on how old your children are. But I don't know of anyone out there who's like, oh, I'm going to get a job so I can get the dependent care credit. It's a result of what you're doing. So a lot of times, working couples have children, they arrange for their children to have childcare, and then they forget about this because they were going to work anyway. Well, they made some changes this year. It's a much bigger credit. Again, it phases out. So if you're in the upper end of the income levels, then you're probably not going to get a benefit. But if you're like most of us and you're right in the meaty part of that curve, there's definitely something there. So if you're preparing your own taxes, I would think that's when you're going to miss it a lot of times because you don't even think about it. So make sure you keep that in mind.
Absolutely. You're absolutely right. Why don't we go to our next slide, because we come into our first polling question, and we can talk a little more about that. The one thing that I also is it's a lot more. So before, if you missed it, it was only like $300 or $600, but now it could be, depending on your income, could be a lot more, like $4,000. So our first polling question.
Here we go. First polling question. Are you or your company actively hedging against potential tax increases? So, a lot of questions. We'll talk about this in more detail a little bit later on, but the common question is, well, how am I supposed to hedge against potential tax increases? If you have $1 of income that you could have taxed today at, I don't know, let's say 20%, and that same $1 of income next year is going to be taxed at 25%, you may want to say, well, let's see if we can get that income taxed this year. And obviously you're going to prepay some taxes. So if you're in a cash crunch, probably not the best idea. But if you have cash that's sitting in, a checking account, not earning anything, you might want to go ahead and use it and pay the tax, and now at the lower rate, and save you some money down the road. So here are our results. It's evenly split, 36 and 36% yes and no. Not sure. That's a very common answer. And yeah, there are potential tax increases coming. So we're going to talk about those and give you the tools to make sure you're thinking about them.
All right. And so let's move on. The next slide, this is probably marked the most important slide for anybody who owns a flow-through business, has rentals, anybody who's operating out there, because this is something that a lot of people had to deal with 2 years ago. It was a huge pain, and then it went away because of the CARES Act. And in fact, it went all the way that they actually reversed it, and now we're having to deal with it again, and it could significantly impact people's taxes. And it was the Section 461 loss limitation. So when Congress came in and we did the Tax Cuts and Jobs Act back in 2017, they had lots of benefits: the reduced tax rate, the qualified business income deduction, all these great things. But the one thing that was a real negative, along with some other things, was this 461 loss limitation. And it's for an individual, if you had more than $500,000 of business losses, and that's after it's gone through at-risk, after it's gone through your passive activity losses, and finally gets onto your Schedule E page 2 and gets to the front page of the 1040. If you had more than $500,000 in losses and you were married, or $250,000 and you were single, the IRS was limiting it, and they were saying, we're only going to let you have up to that amount of losses. So some people, if they had other income in the last 2 years, the losses could eat that and they wouldn't pay any taxes. Now those losses won't be allowed to eat other income. Now the income limitation has gone up a little bit, 262,000 and 524, but it is still there. So people who maybe had big business losses in the past, they might be able to take it. They've also done some technical corrections / updates. It was all done, somewhat last minute when it came through. So it took the service time to get caught up. And now they've had 2 years to do it. They now have some corrections. And one of them is they're not going to allow you to have wages. So if you own an S Corp and you have a $600,000 operating loss and you've paid yourself $100,000 of wages, under the old rules, you would still be under the $500,000 because you could net the wages against it. But now under the new rules with the correction, you would lose that $100,000 of additional loss. So that's one thing. Another thing they weren't sure about were NOLs. So if you had a net operating loss in previous years and you were carrying that forward, would that offset against, would that have to be re-included in the calc? And they said, no, we're not going to. It's a year, looking at the year just on its own without any NOLs or any of that stuff. So that was a positive. And then the 2 other things were they're saying capital gains from trade and business are allowed to be included. So if you've got gains from sale of equipment, you can then use that to increase the loss you're allowed to take. But they've said capital losses are excluded. So it's a heads I win, tails you lose for the service. And then some questions that are still out there are guaranteed payments. And then does the actual disposal of the business actually allow against this loss? And then, so that this is really like the most important thing.
And this created just a whirlwind of opportunities and headaches, and a lot of times with opportunities come headaches. Back in 2020, when the CARES Act came out, back in 2020, it seems like it was like 20 years ago. Back in 2020, when CARES Act came out, it freed up a whole bunch of losses for individuals who had flow-through losses that had been limited by the Tax Cuts and Jobs Act. So it created an opportunity where you could amend a return where you had a loss limited to claim that loss, generate an NOL, and then because of the NOL changes included in the Tax Cuts and Jobs Act, in the CARES Act, you were allowed to carry back those losses 5 years, back to years where individual rates were at their highest levels ever. So created a big opportunity. Unfortunately, the IRS was not able to handle it. One, their systems just aren't made for rapid changes. 2, they sent everybody home. So there was no one in the IRS offices to accept these paper filings, and everything had to be paper filed. So we were amending returns to claim NOLs, and then we were filing what's called a 1045 to carry the NOL back. The problem is a lot of those are still sitting, 1. 2, if the IRS received and processed, even if you sent them at the same time, you had to mail them in, so it's paper. So once they open that envelope, who knows where it goes. If they processed the 1045 first, they would say, you're carrying an NOL back, the system would tell them anyway, you're carrying an NOL back that you don't have. And then, so they would kind of set that aside, and then they might get to process the 1040X and say that would generate then an NOL in the system, but because they set the 1045 aside, they're not processing that. So you're getting one without the other. So that's created a big problem that we're still working through with the IRS.
Absolutely. Yeah, the service is very understaffed. So people have to be patient. It's a great benefit, but you do have to be patient on some of this stuff. All right, let's go to the next slide and talk about charitable donations. So cash donations, you know, they've had some extra things because of the CARES Act and other acts that were passed in the last year. You're allowed to deduct up to 100% of your adjusted gross income in 2021, the same as 2020. In 2022, you'll be limited to only 60% of your adjusted gross income. And then in 2026, as Mark will talk about later, you'll be limited down to back to 50% of your AGI. So the other thing that a lot of people forget about is that if you make any cash donations, and it must be cash, it can't be services, it can't be clothing, there is a additional on top of your standard deduction of $300 for a single person or $600 for married filing jointly returns that you can take. Now, last year it was above the line. This year you'll see it below the line. So if you're someone who's like looking at your return saying, where did that go? They're not going to quite line up. This is a 2-year thing, but it will be going away in 2022. So if you make a donation, you know, there are some benefits here. And I'm going to let Mark talk about charitable donations, his favorite PSA about charitable donations.
Charlie knows that I love to talk about this. So yeah, so we have cash donations that you can take up to 100%, offset 100% of your income in 2021. and you can stack those. So if you have donations of appreciated stock, that's going to be limited to 30%. And then contributions to like a donor advised fund would be 60%. But cash donations directly to a charitable organization, you can get up to 100%. And one question is, okay, I'm maxing out my 30% with gifting of appreciated stock. Should I sell more stock and then donate that cash to get up to use the 100%? And you can do that, but you have to make sure you have enough ordinary income that you can offset with the increased charitable contribution. Because if you're going to sell stock to generate capital gain and then donate that cash, it's a wash. It's just going to go in and out. So to make sure you get that benefit. Now, one question we consistently get year after year after year from clients is, should I make charitable contributions before the end of the year? And my answer 100% of the time is yes, absolutely. Find an organization that you believe in, you know their mission, you like their mission, you want to support them. Go ahead and make a charitable contribution to that organization, obviously assuming you can afford it. Do not do it for tax purposes. If you want to double up donations in 1 year as compared to the next year, so to maximize your charitable deduction that you're going to give anyway, yeah, absolutely. Do it for the tax benefit. But do not do it solely for the tax benefit, because we're not financial advisors, but we do provide financial advice. If you give $1 to save 25 cents, you've still spent 75 cents. So make the charitable contribution because you want to make the charitable contribution, and we will work with you to make sure you get the maximum tax benefit available. But make sure you're making the charitable contributions because that's what you want to do and you believe in an organization and its mission. Don't do it just for the tax benefit. That's my spiel.
No, I 100% agree. So, all right. The next slide is the recovery rebate credit round 3. This has to be reported on your 2021 tax return. A lot of the clients, when we were dealing, they were surprised that we were asking about it. So a lot of them had to go back and dig for your receipts. This is the one that came out in March of 2021, not the one that came out, the second round, which came out in January. That would have been reported on your 2020 tax return. So we're just talking about the second one. So just make sure it's $1,400 per adult and $1,400 per dependent, and there was no age limitation this time. So it's a much bigger credit than in the other one, but the phase outs are much faster. So 75,000 to 80,000 for single people and 150 to 160 for married couples. So if you didn't, if you didn't report the credit and maybe you were eligible for it, you should go back and talk, because you should try to amend your 2020 return, because if you didn't get it and you were supposed to, the service isn't going to give it to you. So make sure you look and think about that, because there's a chance you may have extra money sitting on your 2020 return that you didn't file. So that's just our little PSA. Don't forget about that 2021 recovery rebate credit. Next slide, please. The required minimum distributions. These were suspended in 2020, but they're back in 2021. As part of the Secure Act, it also raised the age from 70.5 to 72. So it's very important that these are required withdrawals. It's due April 1st of the following year when you turn 72, and then December 31st for every year following. And so just remember to take this out, because if you don't take it out, the IRS will charge you a 50% penalty on what you should have taken. So if you have a $25,000 required minimum distribution and you don't take it out, that's $12,500 that you're going to have to pay to the service just to keep that money in. So please, please, please do not forget the RMDs. They're back this year. Don't forget to take them out.
And they should, if you have a managed account, they should just do this for you. They should just cut the check and send it to you. You shouldn't have to do anything. Now, if you have a self-directed IRA, I'm honestly not sure. You probably need to go in and do the withdrawal yourself. But regardless, if you're over age 72 and you have not gotten the check this year from a retirement account, make sure you get it before the end of the year. You're gonna have to pick it up in income anyway. You might as well get the cash.
Right, and then why give the IRS half the money?
There you go. All right, our second polling question, and we're going to be talking about this later on. Do you think the Build Back Better plan will be enacted into law? We let a little bit of wiggle room for people to express their opinions. Yes, no, or you sure hope they do, or you sure hope it doesn't. Every day it's like, it's going to get passed, and then somebody says, I don't think so. It's not going to get passed. So once again, we have another exciting year end of potential tax legislation.
It's never boring, never boring.
I spent the first however many years of my career with looking back, and it was very boring as it pertains to tax, because the laws just didn't change. Well, we've made up for that in the past 4 years.
It is. It's very boring. It's like tax laws become like the Jacksonville Jaguars of tax reform. Boring would be so much better now that they fired Coach Urban Meyer. So let's take a look at the results.
Yeah, we got a majority of people. Well, we have a majority of people saying yes, they will. They do think it'll be passed, and then we have an even bigger number of people saying they sure hope it doesn't. It'll be exciting no matter what happens. All right.
All right, it's payback time. So here are a couple things that happened last year that are going to be affecting your 2021 and 22 tax returns. And so it's important to remember these things that you did last year that are going to have an impact on your return, at least for the next 2 years. And the first one is the self-employment tax advance. So the deferral of employer portion of self-employment taxes, you were able to defer that. So you didn't have to pay taxes on that if you were self-employed. You can defer to 2021 and 2022. And so you have to pay half of it in 2021 and the other half in 2022. And people have already gotten reminders from the service saying, hey, don't forget you deferred this piece and you have to pay it on the next 2 years worth of tax returns. So just a reminder, these things have to be paid, because some people go, oh, they filed, they got this nice little, they got a nice refund they weren't expecting, so that they got some cash, and then they're like, what was this? And then, so just one thing, don't forget. The second one is the retirement withdrawal deferral. As part of the CARES Act, individuals who had hardships with the pandemic could withdraw up to $100,000 from their 401k or original retirement account without penalty. And it can be spent, so that was great because 10% penalty was waived, and they allowed you to spread it out over 3 years. So it could go from 20, and you can only pick up a third in 2020, a third in 2021, and a third in 2022. So that kind of made it easier to take that huge income tax hike there. But the even better part is that you can pay it back at any time until the end of 2022 when you file your return. So if you, you needed that money for something and you took it out, and then, this year things are going really well, you can pay that back, and you can not only do you not have to pick up the income in 2021 and 2022, but the service will allow you to go back to your 2020 return and amend it and get the taxes that you paid on it back. And it's like as though you never took it out, and all you're really out is the interest you could have earned from that money sitting in your account. So this is huge. It's important to remember that you have to pay it back, but if you're in a position where maybe your things are going much better and you didn't need that money anymore, you can pay it back and you can offset the taxes. Also worth noting is that, let's say you're getting ready to file your return and you're like, hey, I could pay this back. If you pay it back before you file your return, you don't even have to pick it up on the return and amend. So if, like in March, you decide, hey, I'm going to pay back the full amount, you don't have to pick up the amount you got in 2021. You can just say you never even got it. So this is real. So that's something I just wanted to bring to people's attention that you can do that'll lessen your taxes and put a little more money back in your retirement account.
And on the self-employment tax or the deferred portion of payroll taxes, clients are starting to get notices now from the IRS saying, here's what you have to pay us before the end of the year. And we're starting to get questions on how that's supposed to be paid. Very surprisingly, the notices are telling you to cut a check as opposed to paying it electronically. Our recommendation is always to pay it electronically. Unfortunately on the notices, it just says to send them a check. And if you look there, it says you include, in the memo line on the check, you include Form 941, indicate that it's for the 941, indicate what quarter it's for, make sure you take note of that, get the right amount. to the right quarter so the IRS applies it correctly, and that it's for the deferral of the payroll tax. If you pay it through EFTPS, which we recommend because then you have documentation, you get a receipt for it, they have added a drop-down box in EFTPS to say that you're applying it to your deferred payroll tax. So we always recommend doing it that way. That way, I feel like it's going to make everyone's lives a lot easier if you do it that way, because as we unfortunately know, even if you indicate everything as it should be shown on the check that you send them, stuff gets applied to the wrong year, it gets applied to the wrong period, it gets applied to the wrong type of tax, and you're going to get a notice saying you owe all this tax, and you're like, I already paid it. And then you're going to have this big overpayment in another area that the IRS doesn't know what to do with. So even when you do everything right, sometimes it gets applied incorrectly. That's why we're a big fan of using EFTPS. And we also, we got a comment from one of our attendees reminding us that instead of taking your RMD out of your IRA, you can donate that, make a charitable contribution directly out of your IRA. And not have to pick it up in income first. So that's another benefit, another tool that you can use to support the organizations that you want to support. Thank you for that.
Yep. Our next thing to talk about is education credits. There are two types of education credits. There's the American Opportunity Credit and the Lifetime Learners Credit. These have been around for years. For some of you who are a little longer in the tooth, you remember it as the Hope Credit, but all they did was add $500 and change the name. But these have been around for a while. The thing is the income thresholds really haven't changed all that much. And in 2021, that's the real thing, is the income thresholds are significantly higher. It went from 59,000, you can see, to 80,000, and 118,000 to 160,000. So you might not have been eligible for some of these credits in years past because of the income threshold. You might find that you are eligible for these credits in 2021. So big change with the education credits is just the fact that, like, a lot more people are going to be eligible to take those credits and the full benefit.
This is definitely another area, if you're preparing your own return, that if you're not paying attention, if you're not really looking at this, you could forget about this and miss it. So make sure you're thinking of these things.
Absolutely. All right. Next is energy credits. These are all of the buzz. If you live in my development, there are solar panels going up everywhere. And so we have some non-energy business credits. The nice part is that they extended the rate up 26% through 2022. So if you put those solar panels in, there's not much time left in 2021, but you can do it in 2022. You get a 20% tax credit on those solar panels. It's for both individuals and businesses, and it's not just solar panels, it's pumps and those things. Can't remember the ones that are, I can't remember what they're called. I'm drawing a blank, but there's those. It's not just solar panels, but that's what most people are getting. And then the other one is for the fueling stations for electronic vehicles. You can get 30% off up to $30,000 in expenses if you put a charging station in your business. But these are great credits if you can do it. There's something to take.
And we're seeing a lot of movement, particularly in the solar panels. There are businesses popping up where they will install solar panels on your property. You essentially don't have to do anything. They come in, they install the solar panels on your property, which generate electricity, obviously. They sell the electricity back to you at a reduced rate. So you have a cost savings on your electricity. If everything is done correctly, you shouldn't notice any kind of difference. And then the company that installs the solar panels are their property. So they get the depreciation on them and they get the tax credits for them. So they win out through picking up the income that they're making from it and getting the deductions and the credits for it, all while you have savings on your electricity bill. So we're seeing a lot of these pop up because of this. So hopefully it's going to continue to advance the solar industry and continue to benefit everybody.
There is a one thing I wanted to mention is that these tax credits for the individuals, when they expire, they go away. There is no tax credit. For the businesses, there's still, I think, is a 10% credit on these things. So for individual, if you're thinking about putting it in your home, you know, better to do it sooner rather than later, because when they go away, there won't be a tax credit, except for businesses where there is still something left after when these rates expire.
And back to the RMDs, we got a question. If a retired taxpayer over age 72 has both a 401k and an individual IRA, so you have two retirement accounts, do you have to take the RMD for both, or would an RMD from either one suffice if the amount withdrawn from one is sufficient to cover both the total RMD amount from both? I don't know the answer to that. Charlie, do you know the answer to that?
I don't off the top of my head. I'm not gonna, I don't want to answer one way or the other. My instinct is that as long as you're taking it out, but there might be some rule saying it has to come out of each, but.
Yeah, well, we can check into that. I would think that as long as you're taking the appropriate amount, then you're fine. The problem is a lot of people don't know what that required amount is, so they don't even know what to do. And if both of your accounts are managed by someone else, they're probably just going to calculate it and send it to you anyway. So I don't know how much control you have over that, but that's an interesting question. If you have, you know, one retirement account that's invested in something that you think is going to take off and you don't want to give that up, yeah, would it be better to take it out of another account, which might be more balanced, less risk or whatever? Yeah, that's an interesting approach. I don't know. We'll have to look into it. And coming up, our next polling question. I need to talk more because we are flying through these polling questions. Which tax-related law or law change do you see impacting you most? The Build Back Better plan or act, I don't even know what the official word is, expiration of the individual provisions of the 2018 tax cuts, which we're going to talk more about in a little bit, the phase out of bonus depreciation, which I think we're on like round 18 of phasing out of bonus depreciation, and we haven't phased it out yet, so I'll believe it when I see it. Or maybe you don't expect any of the tax changes to affect you. Let us know what you think. Charlie, which do you think is going to affect you the most?
Me personally, I think it's probably going to be the expiration of the 2018 Tax Cuts and Jobs Act, and only for the child tax credits that went up, because child tax credits went from 1,000 to 2,000. And so I know that as the tax nerd that I am, that when I did my taxes the first year that these came out, I compared what it would have been under the old law versus what it would have been under the new law, and the only way I made out was with the child tax credits. So I can tell you safely that I know that I won't. So that's my vote.
Well, I fully expect to have in excess of $10 million of income next year. Yeah. So I'm thinking the Build Back Better Act is going to affect me a lot. If I were in that boat, which believe me, I have no reason to believe that I will be, I would be more than happy to pay another 3% or 5%, whatever they're talking about on that excess over 10 million. So. All right, results. Build Back Better plan, expiration of the individual provisions of the 18 tax cuts, that's about equal. Phase out of bonus depreciation, and don't expect any of the changes to affect us. So last two, a little less than the first two, but good to know that people are aware and they're thinking about it.
All right, now the next slides, a couple slides, we'll go through. A lot of them are just obligatory slides that we provide to you guys that have all the tax rate changes, but really it's just a cost of living adjustment. But you know, we'll go through each of them. We have the single filers. Here's all the brackets, same brackets, just the numbers are up slightly. So we'll go to the next slide here. Married couple, same thing. Brackets are exactly the same as last year, but the rates have gone up just slightly. It's going to be second verse, same as the first here. This is for long-term capital gains rates. Just a small $400 increase over last year on the bottom rate, but it's the same thing. Next slide. Married couples, exactly the same thing. You know, just a slight up. So we'll go to the next slide. These are just, single filers, standard deduction, gift tax. I can tell you that a lot of people that we are in the business with that deal with gift taxes, they were doing handstands after they decided really not to do anything with the gift tax exclusion and lifetime estate exclusion for 2021. So that way, all that estate planning can now be pushed off at least for one more year. And they don't have to be as, it doesn't have to be as crazy. The QBI does go up a little bit. AMT, which not many people pay anymore, and then the Social Security goes up. So if you do make more than 137,700, you are going to see a little less in your paycheck because there's going to be a little more Social Security coming out before you hit the max. Next slide.
This, I mean, of the many issues where I don't envy the IRS, them trying to figure out how to index these rate tables has got to just be a nightmare. I mean, here we are, when you have steady 2, 3, 4% inflation, it's not that big of a deal. But, now we're looking at 6% inflation. The latest estimates I'm seeing are that they expect that to go back to normal next year for 2%. So in the short term, it's like, well, you're only indexing these a little bit, but we're experiencing 6% inflation. So you lose then because maybe they're not taking the full 6% into account when they index these. But then the next year, if they go too high, then the next year, if inflation goes back down, as we all hope it does, now we're already ahead. So the IRS now has a problem where they've indexed them too high. And all of these have major impact, particularly the individual rates have a major impact on government budgets. We're talking about literally trillions of dollars. And $100,000 or $50,000 of a rate bracket one way or the other, when you extrapolate that out to all the taxpayers in the US, that can make a huge difference. So just one of the many areas I do not envy the IRS.
Exactly. Yep. All right. These are the married couples. Same thing as the single, just rates are up slightly. And then the next slide. And then we're on to our fourth polling question. So what aspects of the current economy is most affecting you and your business? Is it inflation, supply chain, labor shortage, or other?
Interested to see the results of this one. How many instances are you seeing where companies, they're obviously having to pay more for their raw materials or for their labor costs. They're just passing those costs on to the consumer, but then presumably the consumer, in hopefully many cases, is making more money, so it kind of ends up being a wash. So it's just interesting to see, other than the headache of trying to calculate everything, how much that actually affects things. The supply chain, we're hearing stories of those issues being resolved at least a little bit. So hopefully that isn't causing too much of a headache right now. The labor shortage, yeah, we continue to, there we go. Yeah, we see 38% people saying the labor shortage. Every industry, I've not yet heard of one industry where they're able to find, excuse me, all of the people that they need. And when, 10%, I don't know, it's that high, whatever percent of people just decide, you know what, it's too much of a pain in the butt. I'm just gonna stay home. I don't have to work. I went to work because I enjoyed it, but it's too difficult now. I'm just gonna stay home. That's a real thing. So when you get that many people leaving the workforce, that's what's gonna happen.
The next section we're going to do is we're going to talk about fact or fiction, and Mark is going to go over the topics. He's going to read them to us, and then I'm going to tell you whether they're fact or fiction, and then we're going to discuss it a little bit. And
yeah, Charlie came up with this idea to address this way, to kind of go over the Build Back Better plan. Because there's been so much talk over the past year or so about what's going to be in all these bills, and you get fatigue over the headlines of what's going to be in them. So when the bill actually comes out, it's people don't have time to go through and read it anymore, so they just assume something they heard 6 months ago was going to be in the bill is actually in there. And a lot of times that's not the case. And at the same time, there's stuff in there that no one's ever talked about. So that's why we're going to do this. I thought this was a great idea. All right, Charlie, tell us, C corporation income tax rates, they got to go up, right? We dropped it to 21%. All the talk has been that it has to go back up to 28. I mean, they're going to raise it, right?
Mark, survey says 0.
What?
No, it is not in the provision. I'm sorry to tell you. Corporate rates will stay at 21%.
That is crazy. It's all they've talked about. And they're just leaving it at 21%.
You got to do something.
Yeah, seriously. Yeah, I mean, there's been talk of this consistently. A couple people in Congress made it very clear they will not vote for this if there's an increase in the C corporation tax rates. And as we all know, one vote is the difference now between passing and failing. So yeah, it's staying at 21% at least for now. All right, so in 2018, sticking with C corps, the AMT, alternative minimum tax, went away completely forever for C corporations. Is it coming back?
Unfortunately, Mark, this does have a little truth to it. The proposal would impose a corporate minimum tax of 15% on adjusted financial state income for corporations with income over $1 billion.
So yes, it's coming back. What percentage of C corporations is this going to affect? Now, you might say, well, it's going to affect a lot because, you know, plenty of companies. There are plenty of large C corps out there that have more than $1 billion of income, which is absolutely true. But what it's looking at is your financial statement income. So if your taxable income is more than $1 billion and your financial statement income is more than $1 billion, it doesn't affect you because you're already paying the tax at 21%. What they're going after here is the big headline grabber. It's those companies out there that have, you look at their financial statements and their financial statement income is, you know, 1.5 billion or whatever, but because of credits or deductions, a lot of times related to stock options, eliminates their tax liability or drops them down to such a point where they're not even paying 15% of that. That's where they're targeting. And one thing in particular, the stock option expense, that's been a big headline grabber because it doesn't reduce your book income, but it reduces your taxable income. But what you have to remember is that income is going somewhere and it's being taxed to an individual. And if they're high enough, they're going to be taxed at 37%. So it is being taxed somewhere, but that's what this is going after. All right. R&D expenses, what is going on with those? Are they doing something with them?
Mark, they are. The proposal would delay the effective date of the required amortization of research and development expenses for tax years beginning after 2025.
So this is another one of those push-pull things, because if you're in the market for R&D tax credits, you want to identify every single dollar of R&D that you can. And it's you know, what's R&D? Are you building rockets? You know, yeah, you definitely have R&D. Are you developing an internal software? Yeah, R&D. Are you experimenting on how to produce a product? Well, it kind of depends. So how do we define R&D? And there are a lot of estimates used in this because, you know, you have a person whose salary where they might spend 20% of their time on R&D, maybe they're spending 75% of their time on R&D. So you have to allocate some of that person's salary to R&D, but what's the true percentage of time that they spend? If you're going after the R&D credits, you want to maximize that. If you're not going after R&D credits for whatever reason, you're going to want to minimize that so you don't have to amortize these expenses over an extended period of time. So that's yet another one of these push-pull things. All right, individual income tax rates. I mean, tax rates have to go up somewhere, right? They're going to go up.
Fortunately, Mark, that's another big goose egg here on the hype machine. There is going to be no increase rate, at least in the short term, for individual tax rates.
Huh. Yeah, again, another one of those headline grabbers that is not coming true, at least for this plan. So now, as an addendum to that, what's this surcharge on high income individuals all about? I already gave away the answer.
Oh, you did. Unfortunately, yes. To spoil the surprise, yes, there is. So if you happen to be a coach at one of these major college football programs and you get fired and the buyout's like $12 million, you are going to have to pay a surcharge. Unfortunately, but for most of the rest of us in this country, unless you make more than $5 million married filing separately or $10 million all other individuals, you are going to have to pay an additional 5% surcharge tax. And then if you make more than 12.5 million or 25 million in 1 year, you're going to pay another 3%. So unless you're the very, very, very high-end individuals, you're probably not going to see any tax increase with it. But there is one there. The one area that may affect some taxpayers, more taxpayers, I should say, than this, are on the estates and trusts. If you have more than $200,000 for the estates and trusts, you're going to see that 5%. And if you have anything more than $500,000 in an estate or trust and income, you are going to have to pay 3% more.
All right, so we have this surcharge. Okay, so that's one thing. We already said the C Corp income tax rate is not going up. We already said the individual income tax rates are going up, or not going up. So capital gains rates have to be going up, right?
Nope, not at all. Another swing and a miss, Mark. There is no provision in there for a tax increase. They talked about it, but nope, capital gains rates are going to stay the same.
I think capital gains rates wins the all-time award for the most discussion and the least action, which, you know, isn't a bad thing necessarily. They want capital to be reinvested in companies, and so they want to incentivize that. So let's keep capital gains rates where they are. Net investment income tax. I feel like this is going to be a sneaky one. What's going on?
Well, I've done a little calculations, looked at the stars, brought out my abacus, and yes, there is a change in here in net investment taxes. Essentially what they've done is they've made S Corps and they've taken out a lot of the active investors, and they've said you're either going to pay the net investment tax or you're going to pay the additional Social Security tax. So partnerships, Schedule Cs, those people who were paying the 3.8% additional tax, they were already paying this. But people who were in S Corps or active trader businesses that weren't automatically paying this, now they're saying you're going to have to pay it if you're AGI, if over 500,000 for married couples or 400,000 for single filers, and just expands it so that way a lot of people who weren't paying this, they're going to start paying it. So this is one area that a lot of our clients are going to see affect their returns.
So this is essentially going to put S Corps more on an equal footing with partnerships, and it's going to temper that benefit of keeping, if you're an owner employee of an S Corp, keeping your salary low. So those are the key things to keep in mind there. QBI deduction, please, for the love, tell me they're not going to change it.
Well, I can give you a little early Christmas present here and tell you there will be no change to the QBI deduction. It wasn't so much they were talking about eliminating it, just limiting who could get it. And so, no, there is no change to QBI.
Thank goodness. How about the valuation discounts for estates and gifts?
Nope, unfortunately, survey says 0. No changes here, which a lot of our friends in the valuation and estate and tax planning were super excited to see that none of this was actually going to change. And so far we're okay, no changes.
Whew. All right, that was a lot.
Yes.
Now let's move on to 2026 is the new 2017. This is what we talked about before, where all of the individual income tax provisions from the 2018 Tax Cuts and Jobs Act are set to expire at the end of 2025. Why did that happen? That happened because they had to pass the bill through budget reconciliation, so they were constrained on the long-term effect of the income tax or decreases in income taxes. So they had to sunset at the end of 2025. Are they going to go back now between now and then and change it to make these permanent? I mean, maybe, but unless they change the rules, you're still going to have to get 60 votes. And if you don't, you're going to have to pass it again through budget reconciliation, which means it's going to have to sunset again. So are they going to do anything? I cannot imagine a scenario where they won't do something, because individual income tax rates are going to go back up to 39.6%. That'll be the max rate. The QBI deduction will be gone. The combination of those two things means flow-through entities are now at a disadvantage when compared to C corporations. Long term, I haven't modeled it all out. It still might be better to be an S corp. Short term, it's just when you're going to look at that big tax bill at 39.6%, and then when you start saying, if I were a C corp, I'd only be paying taxes at 21%. That is a tough pill to swallow. So it'll be interesting to see what happens. The estate tax limitation, as we know right now, it's what, 12 and almost 12 and a half per person?
Yeah, it'll be like 12.1 million in 2022.
So that'll go back down to 5 million starting in 2026. So if you know any estate attorneys, they are going nuts right now writing plans to get high net worth individuals to be able to use this limitation now before we get to that point.
Yeah.
Bonus depreciation, I made a joke about that earlier, how they've tried to phase it out a whole bunch of times. No indication yet that this isn't going to change. So as of right now, beginning in 2023, so assets placed in service after December 31, 2022, bonus depreciation will go down to 80%, and then it's going to drop 20 more percentage points each year after that until it's gone. So there's our quick update on the expiration of the Tax Cuts and Jobs Act. Finally, thought we'd throw in here something about, so there's been some movement on Pennsylvania. Charlie, do you want to talk about the education tax credits?
Yeah, the education tax credits, these are, and the opportunity scholarship tax credits, these are very popular with a lot of people because you can make donations and direct them to where they're going to go, and the state's going to give you a tax credit for it. In the past, these were use it or lose it credits. So if you had it and it's in your business, you would have to pass it down to the individual, and then they would take it on their return. But if you bought $10,000 worth of credits and you could only use 6, well, then that $4,000 worth of credit you were lost. Now for this year and this year only, I believe they're allowing you, if you don't allocate it, which means if you keep it at the business level and don't distribute it out to the shareholders, you can roll it forward for 1 year. So that's huge because it's allowing people who maybe don't have a lot of tax, maybe not as much state tax as they'd like, they can roll it forward and then carry it forward to next year. So they can still give the money that they want. It can get to the charities, but they won't lose it. So it was kind of a nice thing this year, an unexpected gift from the state.
And 179, which when you compare federal to Pennsylvania, I'm really happy to see PA at least considering this. The 179 expense deduction is currently capped at $25,000, which, I mean, good grief, that's like from the Stone Ages. So at least federally figured out that they need to expand that. Hopefully PA will pass this to match federal.
Yeah.
Like-kind exchanges, go ahead, Charlie.
Yeah, like-kind exchanges, I mean, like-kind exchanges are the bane of tax preparers' existence because it was for years that cars, if you bought and traded in cars, which businesses who have any type of fleet, they're constantly changing them in, you would have to defer the gain and these cars would be practically worthless, and there was all this back and forth. Well, the IRS said, you know what, we're not doing this anymore, and they got rid of like-kind exchanges. But the state is still doing it. It would be so nice if they would just follow federal instead of having to keep completely different depreciation reports and everything. It would be nice that they followed along and did exactly what the state did.
Yes, I am glad that they limited it to real property because the example you gave is a real painful one.
So, and then the last thing is the pass-through entity tax credit for residents. This is because we're limiting our itemized deductions to $10,000 for state and local taxes. And so some of the higher tax states, California, New York, New Jersey, we're trying to find ways to get it so that those taxes will be part of the business income side and not the individual side. So what they did is they made these credits. Well, Pennsylvania came back and said, if you take it as a business line, we're not going to give you a credit for taxes paid in other states. So what they did is they said you have to either pick or choose. You can either get the credit on your Schedule A, I mean, reduce your income and not get the credit on Schedule A, or you can get it as an out-of-state credit. So for S Corps, you're allowed to do it, but for other entities, you're not. And so I've had some clients where they've had to make those decisions whether to opt in or opt out. And it's probably better to opt out and not take it on the Schedule A, because if you're in California and you're paying a huge amount of tax, you're going to get no benefit for that in PA. So please make sure you're consulting with your tax advisors about these pass-through entity taxes for resident credits to make sure that you're not, wasting money when you don't have to.
All right. So we have a couple comments, couple questions that came in. Looks like some people are doing our tax research for us, which I greatly appreciate. One comment says, if you do have multiple retirement accounts, it looks like you can pick and choose where your RMD comes from. So that is a helpful tip. We appreciate that. Let's see, is the corporate minimum tax related to the global minimum tax? It absolutely is. It's meant to mirror what G7 or G9, whatever it is now, what their handshake deal there, where they're trying to create a level playing field across the world so that companies, mega companies, can't pick and choose where to put their headquarters, that they're going to have to pay the tax, at least the 15% minimum tax, no matter where they go. So yes, it absolutely is related to that. Any other questions? Get them in here if you can. We have another minute or two.
We do have one question about solar panels on top of vacation homes, and the answer is yes. If you do put solar panels on your vacation home, you can still get the credit. It can't be an investment property or it can't be some sort of mixed use, but if you have a second home at the beach and you want to put solar panels on there and reduce it, you are more than eligible for the credit.
Cool, thank you.
Yep.
All right, well, there you have it. If you do think of anything else, comments, questions, concerns, what have you, there you have our contact information. Feel free to reach out to us. And let's see, non-business energy property credit, does that include heat pump systems? One question in under the wire.
Yes, that was what I could not remember. Yes, those heat pumps. Yes, those heat pumps, when I couldn't remember what it was called. Yes, the heat pumps are included in there. Solar panels get most of the headlines, but there are credits out there. The heat pumps are included in there as well.
Thank you very much. All right, everyone. I hope you have a wonderful rest of the day. The Liverpool game starts in 2 minutes, so I would highly recommend that all of you turn that on and watch some very entertaining soccer. And go Reds. Thank you, everyone. And until next time, we'll see you. Happy holidays. Happy New Year.